Appraisal of REO and Foreclosure Properties. Chapter 2, Instruments Used in Foreclosure. Page 16, Repayment Plan.
Repayment Plan. Under a repayment plan, the debtor resumes normal payments with the addition of partial payments of the past due amount until the debtor comes current. This type of plan is often used when just a few payments are missed due to a short-term life event, such as a temporary job layoff. This type of plan must be agreed to by all parties in the transaction. If the life event that triggered the default is long-term, such as a permanent job loss or death of a co-borrower, a repayment plan is usually not a viable option. A repayment plan may be used in conjunction with forbearance, in order for the borrower to make up the payments that were missed during the forbearance period. End of page. Repayment Plan. Under a repayment plan, the debtor resumes normal payments with the addition of partial payments.
Page 17, Mortgage Modification.
Mortgage modification. A mortgage modification occurs when the lender and borrower agree to change one or more of the terms of the loan. This could include reduced interest rate, conversion of a variable to a fixed rate, extending the term of the loan, and adding the payments to the back of the loan. A reduction, write-down, of the outstanding principal balance. Touted by consumer advocates as an alternative to foreclosure, mortgage modifications were at an all-time high between the years of 2010 and 2012. Because these were the peak years for foreclosures, lenders did not want to add to their already large inventories of REO properties, hence they were more willing to negotiate loan modifications with borrowers. There were other factors contributing to the number of mortgage modifications, including social and consumer pressure on lenders and government-backed incentives for lenders to modify mortgages. While not a total win-win, a mortgage modification does provide some benefit to both parties. The borrower gets to keep the property under terms they can more easily afford. The lender still receives payments, albeit smaller ones, and does not have to go through the expensive and time-consuming foreclosure process. Mortgage modifications may or may not require the services of an appraiser. Mortgage modifications are not a panacea, however. According to a study by Fannie Mae in 2015, approximately 36% of the mortgages that were modified in 2010 under the Home Affordable Modification Program, HAMP, ended up in default within 36 months of the modification. Borrowers who wish to modify their mortgages may negotiate their own loan modification terms directly with lenders. However, there are a number of individuals and companies who offer to negotiate with the lender on the borrower's behalf. Many of these mortgage modification companies are legitimate, however some are scammers who take payments from cash-strapped borrowers but perform no services. It stands to reason that mortgage modification is a tool that lenders would use to try to reduce the number of foreclosures, particularly given the financial difficulties that many borrowers have experienced as a result of COVID-19. However, it remains to be seen what role mortgage modification will play in the post-COVID world. End of page.
Page 18, Claim Advance.
Claim advance. If the loan is insured by the government, FHA, or by private mortgage insurance, PMI, the borrower, debtor, may qualify for an interest-free loan in order to bring the loan current. This is called a claim advance. Repayment of this loan may be delayed several years or not occur at all until after a subsequent sale of the property. With a mortgage that is insured, the mortgage insurance company is on the hook for the difference between the amount owed and the eventual sale price of the property, as well as the foreclosure costs. For example, let's say a property is worth $200,000 and the borrower owes $240,000 on it. Foreclosure costs are approximately $24,000, 10% of the mortgage balance, so the mortgage insurance company is facing a potential loss of $64,000. If the mortgage insurance company can advance a loan of $6,000 to the borrower to cover missed payments and bring the mortgage current, that is staving off foreclosure. It is a good deal for them, so long as the borrower does not go back into default. A claim advance often requires an appraisal, but some companies will accept a broker's price opinion, BPO, in lieu of an appraisal. End of page.
Pre-foreclosure or short sale.
Pre-foreclosure or short sale. In a short sale, sometimes also called pre-foreclosure sale or compromise sale, the lender is willing to accept less than the full amount owed if the sale price of the property does not cover the outstanding loan balance. Most often this will require the services of a professional appraiser and a professional broker/agent or auctioneer. There must be clear evidence that the property at sale will not yield enough to cover the amount owed. Usually it would also require a solid purchase contract on the property which came about as the result of reasonable exposure to the open market. Because of the potential for abuse, before agreeing to the short sale, the lender needs to be sure that the property will bring no higher value regardless of any action by any party. An appraisal report prepared by a professional appraiser is perhaps the best way to show a mortgage lender that the property value is commensurate with the pending sales contract and is indeed less than the outstanding loan balance. Historically, short sales have been done in areas where market conditions have changed dramatically, for example declining markets, economically distressed area. Between 2007 and 2012, when property values declined throughout much of the United States, short sales became more commonplace. Even though the national housing market has recovered, short sales still continue to take place. Like with mortgage modification, there are real estate professionals who advertise themselves as short sale specialists or the like. End of page.
Page 20. Sale.
Sale. The lender might agree to provide the borrower with a specific amount of time to sell the property for the full amount owed or more. This assumes the property can be sold for more than the outstanding mortgage balance, otherwise it would be considered a short sale. Most lenders would require a professional broker/agent or auctioneer to conduct the sale. Normally, this would require an appraisal prior to, or in conjunction with, the listing. It may also include forbearance as part of the sale timeline. This type of loan workout solution may not require the services of an appraiser. However, in many cases an appraisal will be required for the new purchaser's mortgage. End of page.
Page 21. Assumption.
Assumption. The lender may agree to permit a qualified new borrower to assume the existing loan, regardless of whether the original loan allowed for this provision or not. The terms may require the new borrower to bring the existing loan current and most often will require the services of a professional appraiser. End of page.